So thanks for clicking on and listening to this video today. Today we're going to talk about the CEAP, the Corporate Equity Endorsement Plan. And this is a plan that we designed for business owners of high wealth, high earnings. It could be executives that are high earners for the company. And this is a plan where the company controls the asset, carries it on its books, and establishes the plan, which can be extremely flexible for the owners of a company. It's not for rank and file. And I'm going to go through all the particulars in about 13 minutes. And I think you'll learn an awful lot about the endorsement equity plan that's designed for corporations with high earning owners. So thanks for popping in. And after we go through this, if you have any questions, you can email me or give me a call and we can talk about it. So, as I have mentioned, we're here to talk about the Executive Compensation Program, the Corporate Equity Endorsement Executive Compensation Plan. And this is built for key people, high earners, owners of companies. And it has many purposes, but we're going to cover some of the benefits and the purposes and how it works today in about 8 to 10 minutes. And you'll have a really good idea of what we're trying to do when we try to give a benefit to an executive or an owner using the cash flow of the business. Well, some of the things you might want to know about is that we try to put these type of programs together for a couple of different reasons. Shelter extra income. For an example, we have a person that doesn't want to show a lot of income because of personal reasons. We can set up an endorsement benefit so we can shelter that income from current taxes. We can create personal wealth on a tax advantaged methodology outside the business. Like I've said, too many business owners have too much wealth in their business, and consequently, when they try to get it out when they need it, they can't get it out, or it's costing them a fortune tax-wise. Enhanced benefits, from death benefits, tax-free income, critical illness, chronic illness, the benefits that you need should you find yourself in a position of having an illness, a chronic situation, or a death. We want flexibility of the retirement income and survivorship benefits, and by using the endorsement method, we could have the controllers of the company put together programs make sense for each executive or owner. And we can create the ability to fund the cost of the key person group. It's nice to know that if I'm going to give a benefit, I have the funding mechanism rather than just purely cash flow. And we can create a tax-free bank for the family, an income stream if so. So we have a lot of opportunities to change things around, and it's very flexible. Now, the executive plan, how it works is the company applies for cash-rich life insurance and tax-advantaged life insurance programs. This is a program designed really to be all about creating of cash, and it's wrapped in a life insurance benefit. And because of that, we get very good tax advantages by tax deferral and also on withdrawal tax-free. So this is a nice blending of money to create some advantages down the road. Normally the company is the owner, and the company establishes a benefit for the executive. That could be death benefits, retirement, both pre and post retirement, and pre and post retirement and death benefits, and critical and chronic illness and injury. That's a big one as we get older, the chronic illness especially. And these are wrapped up into these policies that work very, very well as a benefit. The changes are really, we find ourselves when we create these benefits having many options. We can roll out that plan to the executive The company can keep it for a particular reason. They may want to have insurance on the owner, maybe one of the kids of the family who owns stock, to redeem the stock upon a death. We can use it to create increased benefits through a death benefit only program where we can, on a pre and a post basis, pay the family a larger death benefit that's deductible and also funded. So there's a lot of things that you can do with this particular program. Now, for the company, they establish the compensation level. In other words, how much am I going to put into this thing? Okay? How much am I going to contribute? It carries the asset on the books, which is very favorable as an asset. And the accountants jump for joy, and so do the bankers, because we've got an asset that's growing that has the ability to extract tax-free, and upon death is paid to the company on a tax-free basis. And of course, for an example, if you were a pass-through company, let's say an S corporation, and death occurred, you have this run of income coming in that's non-taxable to increase your cost basis in your stock. A very good maneuver. It has the access of the cash value for any reason. The company owner could actually use it for buying inventory, turning inventory, and putting it back into the plan. So, for an example, can you use it to loan for vehicles? Yes, you could loan it to the executive to buy the car, and they could pay it back. A lot of uses. So let's take a look at the funds the way we can benefit by using the program. Let's say there's a death benefit of $100,000 a year for 10 years, let's say $1 million. In a 30% tax bracket, it costs the company $700,000 after tax. If the death benefit from the policy was $1 million, it would be tax-free. The company could have $300,000 of tax-free available after they fund the payout to use any way they want. And in many cases, it could be used to buy a new key person, to find a CEO to run the company until we find a replacement. On the second model here, if the executive retired and the agreement was $100,000 for 10 years, it costs the same, $70,000 a year or $700,000. But if there was cash value of $1.2 million, the company still has the same situation. They are going to use $700,000 to fund that $1 million benefit, but they're going to end up with another $500,000 available to do what they want. So that's a good deal, and those are two good examples. Now, here's a perfect example of the funding. Over here we have the deposit by the corporation, which is $70,000 a year, into the plan. In this particular case, the executive was going to have an increase in $70,000, did not want it in their income. So we put it into the endorsement plan and set up a post and pre-benefit. In the post-benefit, meaning retirement, the agreement was they would pay $138,300 of gross payout. Well, that happens to cost, after an after-tax basis of 30%, or after-tax cost, we'll use that, $96,000 and change. But it could have been anything here. The point is that we're funding this for over 20 years, but we could set it up for a 10-year payout and still have the excess cash that you'll see over here available to use in the future. And this could have been changed. This could have been added more. It could have been less. And we could have also taken this death benefit and said between now and the time you retire, let's call retirement 70, if there's a death, we'll pay X amount of dollars for 10 years or 20 years, whatever it might be, to the family. And this is purely funded tax-free. And as you can see, we funded it for 20 years. And the policy at 5.5% is performing very well. And again, these are adjustable things that change over time. That's why we review everybody every year to find out, are we still on course? So let's take a look how it looks. First of all, the company contributes the premium and sends it to the insurance company. The insurance company creates the benefits in the policy that the company owns. Concurrently with that, there's a handshake agreement or an agreement that says basically, if you retire with us, we're going to pay you X amount of dollars for X amount of years. And if you die prior to that, we're going to pay a payout for X amount of years. And it's an agreement. And it's funded through the insurance plan. And this certainly can change. If the executive died after receiving pre-retirement or retirement benefits, there would always be a death benefit payable to the family. Now, anything in excess of these benefits, certainly the company can use to create very nice cash flow to create a fund to either get new key people, build up their middle management, pay debt, whatever it might be. And as I speak about this, we're a Tier 1 benefit plan. So for an example, Tier 1 would be tax-free benefits, paid-up life insurance, the family bank, supplemental retirement programs, salary continuation, kind of the living benefits and also the death benefits. Tier 2 would be those critical illnesses, those chronic illnesses, terminal illness, death benefit only. Tier 2 plans are usually used for the up-and-coming executive, where Tier 1 is usually the owners and the high-level executives. And so through this methodology of using the CEEP program, we can create different benefits for different groups. And again, you can carve out who you want in the plan and what you want. So again, thanks again for taking the time. And should you have any questions, email me or give me a call at this number. Thank you. So there you go. I think this is a wonderful plan. I think the endorsement equity plan gives companies the opportunity of creating a lot of flexibility for their highly paid people. They can make changes. They can adjust it on a dime based on company situation. I like the idea too that the benefit, not the benefit, but the funding of it is out of the taxation of the employee. In many cases, you don't want to show that income, but again, it's owned by the company, and the people that are usually getting this benefit control the company. So again, if you have any questions, certainly give me a call at 203-530-6615, or you can email me at tperrone@necgginc. And I want to thank you for taking the time to listen to this video. Thank you.